Hi, welcome to watch the second video of corporate finance. Today's topic is valuing stocks. In the first video of corporate finance, it was mentioned that when managing an IPO deal, the underwriters use two approaches to evaluate the firm. The first approach is based on discounted cash flows, and the second approach is to use valuation multiples based on comparable firms. In this video, we will look at both approaches in detail. The first part of the video is stock valuation based on discounted cash flow. This approach is driven by law of one price. That is, the price of a security should equal the present value of the expected cash flows an investor will receive from owning it. There are three methods under this approach. The first method, valuation based on dividend payments and capital gains of a stock. Discount factor being used is the equity cost of capital. The outcome of this method is the value of a single stock. Method 2, valuation based on total payments, including all dividends, capital gains, and repurchases. The discount factor is also the equity cost of capital, and the outcome is the total market capitalization of the firm's equity. Method 3, valuation based on free cash flow, which is the cash available to pay all security holders, including both the shareholders and the debt holders. The discount factor used in this method is the weighted average cost of capital, and the outcome is the firm's enterprise value. Let's take a look at method 1, the dividend discount model. There are two potential sources of cash flows from owning a stock: the dividend payments and the capital gains when the share is sold at some future date. The value of the stock is independent of the investment horizon N. So in a special case where the stock is held in perpetuity, the model can be formulated as like this. That is, the price of the stock is equal to the present value of the expected future dividends it will pay. The equity cost of capital here is the expected return of other investments in the market with equivalent risk. Dividends versus investment and growth. What should the firm do if it wants to increase its share price? In order to answer this question, let's take a look at a simplified case. Applying a constant dividend growth rate G to the dividend discount model, we get the stock price to be calculated as the dividend for the next year divided by the equity cost of capital minus the dividend growth rate G. Without raising additional capital, the firm faces a trade-off. It can retain earnings to invest more. Then the dividend growth rate would go up, but the dividend for the next year would go down. Or it can pay more dividends and cut investment. In that case, the dividend growth rate G would go down, but the dividend for the next year would go up. So how should the firm decide when it comes to splitting its earnings? It really depends on the profitability of the firm's investment. In reality, the dividend growth rate is usually not constant, but it won't change the conclusion made based on the assumption of constant dividend growth rate. The limitation of the dividend discount model is that there exists a large uncertainty associated with forecasting a firm's future dividends, which requires forecasting the firm's earnings, dividend payout rate, and future share count. The dividend discount model implicitly assumes that any cash paid out by the firm to its shareholders takes the form of a dividend. However, in recent years, an increasing number of firms have replaced the dividend payouts with share repurchases. Share repurchases is when the firm uses excess cash to buy back its own stock. So, to cater for the situation when a firm plans to repurchase shares in the near future, the total payout model was introduced. And the price of a stock can be derived from the total payout by dividing the present value of total payouts by the share outstanding. There are some key differences between the dividend discount model and the total payout model. The first difference, the total payout model values all of the firm's equity rather than a single share. The second difference, the total payout model uses the growth rate of total earnings when forecasting the growth of the firm's total payouts. The discounted free cash flow model estimates the enterprise value from the forecasted free cash flow. The enterprise value is the value of the firm's underlying business, unencumbered by debt and separate from any cash or marketable securities. Since the free cash flow is the cash generated by the firm that is available to pay all investors, both debt and equity holders, the discount factor used in the calculation is the weighted average cost of capital. And the long-run growth rate of the free cash flow is typically based on the expected long-run growth rate of the firm's revenues. The enterprise value can be interpreted as the net cost of acquiring the firm's equity, taking its cash, paying off all debt, and thus owning the unlevered business. Therefore, one can derive the price of a single stock from the estimated enterprise value. Because the firm's free cash flow is equal to the sum of the free cash flows from the firm's current and future investments, we can interpret the firm's enterprise value as the total net present value that the firm will earn from continuing its existing project and initiating new ones. With that being said, the implication of the discounted free cash flow model is that to maximize the firm's share price, projects with a positive NPV should be accepted. The second part of today's video, stock valuation based on comparable firms. The method of comparables estimate the value of the firm based on the value of other comparable firms or investments that we expect will generate a very similar cash flow in the future. There are two common valuation multiples. The price-earning ratio. The price-earning ratio estimates the value of a firm's share by multiplying its current earnings per share by the average PE ratio of comparable firms. There are two types of PE ratios. When you use the expected earnings for the next 12 months, you get the forward PE ratio. If you use earnings over the prior 12 months, then you get the trailing PE ratio. The forward PE ratio is preferred for the valuation purpose. Another common valuation multiple is the enterprise value to EBITDA ratio. EBITDA is earnings before interest, tax, depreciations, and amortizations. Depending on the nature of the firm to be evaluated, there are some other useful valuation multiples. For example, if the firm has substantial tangible assets, then one can use the ratio of price to book value of equity per share. And if it is reasonable to assume that the firm will maintain similar margins in the future, then the ratio of enterprise value to sales could be useful. Limitations of the comparables approach includes ignore the important differences among firms. Only provide information regarding the value of the firm relative to the other firms in the comparison set. In other words, it doesn't provide information on the absolute value of the firm. Part 3, which is also the last part of today's video, comparison of two approaches. Discounted cash flow approach is complicated and involves lots of uncertainties, but it allows us to incorporate specific information about the firm's profitability, cost of capital, and future growth potentials. The comparables approach provides only relative valuation of the firm, but it is simple and it's based on actual prices of real firms rather than what may be unrealistic forecasts of future cash flows. Thank you for watching. Have a nice weekend.